Imagine a single, deliberate financial decision that doesn't just secure your own retirement, but begins a legacy that can support your children, your grandchildren, and perhaps even their children. This is the promise of generational wealth, not a mythical fortune reserved for dynasties, but a tangible financial foundation built on patience, discipline, and the most powerful force in finance: compound growth. The vehicle for this transformation doesn't have to be complex. In fact, its simplicity is its greatest strength. Today, we're exploring a compelling blueprint for building that foundation. It centers on one idea: taking a substantial but achievable sum, $100,000, and deploying it not into speculative bets, but into a fortress of predictable, growing cash flow. The engine for this plan is the Schwab U.S. Dividend Equity ETF, known by its ticker SCHD. This isn't a story about getting rich quick. This is a story about getting rich surely, about how a single, well-structured investment can work relentlessly across decades to fundamentally alter your family's financial destiny. First, we must understand the why before the how. Generational wealth is more than a large bank account. It is financial resilience. It is the safety net that allows future generations to pursue education, start businesses, buy homes, and take career risks without the crippling anxiety of living paycheck to paycheck. It breaks the cycle of needing to start from zero. The traditional path to this has been real estate or owning a family business, but these require significant management, expertise, and concentrated risk. The modern accessible path is through the ownership of financial assets, specifically a diversified portfolio of high-quality companies that share their profits with shareholders. This is the domain of dividend investing, and not just any dividends, but dividends that grow year after year. This growth is the key that unlocks exponential wealth over time. It protects your income from inflation and steadily increases your share of corporate profits without you needing to invest another dollar. This is where SCHD enters the picture. SCHD is not a stock, it is an exchange-traded fund, a basket of 100 large U.S.-based companies specifically selected for their commitment to paying and growing dividends. Its methodology is a rigorous filter. It screens for companies with a strong market capitalization, ensuring they are established industry leaders, a solid dividend history of consistent payments for at least a decade, strong fundamental health based on cash flow, debt levels, and return on equity, and a high dividend yield that is also sustainable. The result is a concentrated portfolio of cash cows, companies like Broadcom, PepsiCo, Merck, and Verizon. These are not flashy tech startups. They are mature, profitable enterprises in sectors like healthcare, consumer staples, and industrials that generate massive, reliable cash flows. SCHD owns them for you, automatically rebalancing the portfolio and reinvesting the dividends if you choose. It is a one-stop shop for disciplined, growth-oriented dividend investing. Now, let's project what a $100,000 initial investment in SCHD could potentially do over a multi-decade timeline, assuming a conservative but historically grounded set of returns. We will look at three critical forces: dividend yield, dividend growth, and share price appreciation. Historically, SCHD has yielded between 3% and 4%. Let's use a conservative 3.5% as our starting yield on a $100,000 investment that generates $3,500 in annual income in year one. Crucially, the fund's underlying companies have grown their dividends at an average annual rate of about 10% over the past decade. Let's assume a more conservative long-term dividend growth rate of 7%. Finally, while past performance is no guarantee, the share price of a fund holding growing, profitable companies tends to appreciate over time. We'll assume a modest 5% average annual share price growth. The magic happens when you reinvest all dividends, a strategy known as DRIP, or Dividend Reinvestment Plan. You take that $3,500 in cash and use it to automatically buy more shares of SCHD. In year two, you now own more shares, which themselves pay a dividend that is also 7% higher. You are compounding on multiple levels. Your number of shares is growing, and the dividend per share is growing. The results over 30 years are transformative. After 3 decades of reinvesting, your annual dividend income would balloon from the initial $3,500 to over $26,000 per year. Your original $100,000 investment would have grown to a portfolio value of approximately $660,000. Crucially, you achieved this without ever adding another dollar of your own capital after the initial investment. The system worked entirely on autopilot. But the true generational shift occurs when you stop reinvesting and start harvesting the income. Let's say you are 35 years old when you invest the $100,000. By age 65, your portfolio is generating that $26,000 plus in annual dividends. You can now use this income to supplement your retirement, dramatically reducing the amount you need to withdraw from your principal. This protects your nest egg. More importantly, you can choose not to spend it all. You can use a portion of this reliable, market-independent cash flow to fund 529 plans for your grandchildren's education, or to provide your adult children with a down payment for a home. You are now actively funding the next generation's major life milestones without eroding your own financial security. The strategy's power is further amplified through estate planning. Assets held in a brokerage account like this typically pass to your heirs with a step-up in cost basis. This means that for tax purposes, the value of the investment is reset to its market value on the date of your death. Your heirs inherit the $660,000 portfolio, or whatever it's worth then, without having to pay capital gains taxes on the $560,000 growth that occurred during your lifetime. They can then choose to continue the dividend reinvestment strategy, amplifying the wealth further, or use the substantial income for their own needs. You have effectively created a perpetual low-maintenance family asset. Of course, this blueprint is not without its caveats and requires a steadfast mindset. It demands extreme patience. You must be willing to ignore market volatility, economic headlines, and the temptation of speculative trends. The strategy only works if you hold consistently through multiple market cycles. You must also commit to total dividend reinvestment for the entire accumulation phase. Taking the cash for vacations or cars in the early years critically undermines the compounding engine. Furthermore, while SCHD's methodology is robust, it is not immune to significant market downturns or periods of underperformance. Diversification across other asset classes is still prudent. Finally, you must have the capital to begin. Saving $100,000 is a monumental task in itself, requiring its own discipline of aggressive saving and budgeting over many years. In conclusion, building generational wealth with SCHD is not a secret hack. It is the diligent application of time-tested financial principles through a supremely efficient tool. It transforms $100,000 from a static sum into a dynamic income-generating engine that grows more powerful with each passing year. It replaces complexity with simplicity and speculation with certainty. This plan is about making a definitive choice today to plant a tree whose shade you know your family will enjoy for decades to come. It is a quiet, confident bet on American capitalism, on the power of profitable businesses, and on the mathematical inevitability of compound growth. By focusing on the relentless accumulation of cash-flowing assets, you aren't just investing in a fund, you are investing in your family's future freedom, security, and opportunity. That is the true transformation from a saver of money to a builder of legacy. The transformative power of this strategy lies not in its complexity, but in its elegant, almost mathematical simplicity. However, to move from a promising projection to a lived reality requires a deeper understanding of the underlying philosophy, the psychological fortitude to withstand decades of market noise, and a clear-eyed view of the tax and estate planning mechanisms that truly cement the generational aspect of wealth. This is a financial marathon, and success depends on understanding the course, the conditions, and the required mindset. At its core, the SCHD strategy is a bet on quality, durability, and shareholder-friendly management. The fund's selection criteria act as a formidable filter, systematically excluding companies that are financially fragile, over-leveraged, or unwilling to prioritize returning capital to owners. The resulting portfolio is a collection of economic stalwarts. These are companies that produce essentials: medicine, food, telecommunications, financial services. Their demand is non-cyclical. They possess wide economic moats, brand loyalty, regulatory licenses, massive scale, or proprietary technology that protects their profits from competitors. This is critical for generational wealth. You are not investing in the next big thing. You are investing in the ongoing profitable things. These companies generate free cash flow far in excess of their operational needs. That excess cash is what funds the dividends. By owning SCHD, you are effectively buying a share of the cash flows of 100 such enterprises. Their collective resilience is your portfolio's bedrock. During economic downturns, while their stock prices may decline with the broader market, their underlying businesses are far less likely to see catastrophic collapses in earnings. This stability ensures the continuity of the dividend, which is the lifeblood of the compounding process. The psychological dimension of this journey cannot be overstated. The greatest threat to the strategy is not a market crash, but investor behavior. The path of compounding is not a smooth upward line. It is a turbulent, jagged climb filled with stomach-churning drops. There will be years, perhaps several in a row, where SCHD underperforms a soaring technology index. The temptation to abandon the slow and steady dividend approach for the allure of rapid gains will be powerful. This is where an understanding of regret minimization becomes crucial. For generational wealth building, the goal is not to maximize returns in any single year, but to minimize the catastrophic regret of permanent capital loss or a failed plan. SCHD's methodology inherently minimizes regret by avoiding speculative, unprofitable companies. Your future self and your heirs will not regret missing out on a meme stock bubble that eventually burst. They will be profoundly grateful for the relentless, predictable accumulation of income-producing assets that survived every crisis. This requires a near-robotic discipline. You must view market downturns not as disasters, but as opportunities for accelerated compounding. When share prices fall, your automatically reinvested dividends buy more shares. A lower price means a higher yield on cost for those new shares, which then benefit from the same dividend growth trajectory. Volatility, therefore, becomes your silent partner, helping you accumulate more of the cash-flowing asset at discounted prices over time. Tax efficiency is the silent engine that can dramatically accelerate or hinder wealth accumulation. SCHD, as an ETF, is inherently tax efficient due to its structure. It typically generates far fewer capital gains distributions than a traditional mutual fund, thanks to the in-kind creation/redemption process. However, the dividends it pays are taxable in the year they are received, unless they are held in a tax-advantaged account like an IRA or 401k. This presents a strategic decision point. Holding SCHD in a Roth IRA is perhaps the ideal scenario for this strategy. The dividends compound tax-free, and all withdrawals in retirement for the original owner are also tax-free. For generational wealth, a Roth IRA can be passed to heirs, who will then be required to take distributions. But those distributions will also be tax-free for them, a monumental advantage. If using a taxable brokerage account, one must be mindful of qualified dividend status. SCHD's dividends are largely qualified, meaning they are taxed at the lower long-term capital gains rate rather than ordinary income rates. This still creates a tax drag each year, but at a minimized level. The ultimate tax advantage, as mentioned, is the step-up in cost basis at death, which effectively erases the capital gains tax liability for your heirs on all the growth that occurred during your lifetime. This makes the taxable account a powerful vehicle for legacy building, despite the annual dividend tax. Finally, it is essential to view SCHD not as a solitary solution, but as the core foundational pillar of a broader generational wealth plan. As the portfolio grows exceedingly large, considerations for further diversification may arise. This could involve allocating a portion to broad market index funds, like VTI, for additional growth exposure, or to municipal bond funds for tax-free income in later years. The SCHD core, however, remains the unwavering source of growing predictable income. Its role is to provide the financial security and cash flow that allows the family to take calculated risks elsewhere, funding a child's startup, pursuing advanced degrees, or investing in real estate without jeopardizing the family's foundational stability. In the final analysis, the strategy of deploying $100,000 into SCHD is a vote for certainty in an uncertain world. It is a commitment to the principle that owning a piece of durable, cash-generating businesses is the most reliable path to permanent wealth. It requires the patience of a gardener, the discipline of a soldier, and the vision of an architect. It forgoes the adrenaline of speculation for the profound satisfaction of security and legacy. By systematically converting capital into an ever-expanding stream of owner's income, you are not merely building a portfolio, you are constructing a financial artery that can sustain and empower your family for generations. The initial sum is important, but it is the system, the philosophy, and the time that truly perform the alchemy. You are not just leaving an inheritance of money, you are leaving an inheritance of financial intelligence, discipline, and freedom. That is the ultimate transformative power of this simple, profound plan.